There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
So with that being said, let's go to the charts. That's always the fun parts, when you're showing the charts. Let me do this. Take a look at the Forex Factory. I don't know if you guys know, it's actually a bank holiday in China this week. I'll tell you, it's pretty interesting, by the way. I don't know if you guys have caught how many companies have actually exited the Chinese marketplace. Google is one of the new announcements, if you will, to exit the Chinese marketplace. This is the reason a lot of these Chinese stocks have gotten absolutely clobbered. I don't care if it's Shopify or Alibaba or whatever. The disassociation with anything made in China is becoming more and more prevalent in terms of the U.S. based upon a bananas-ly ridiculous hostile regime that is in bed with Putin. So we will not spend any more time on our soapbox other than to just let you know we are caring less and less. So, and that's probably a good thing, right? It's kind of like energy independence as a country. Critically important thing. So, as I had mentioned yesterday, Powell spoke. I'm not sure who saw that. He had mentioned that due to speak about digital assets and financial stability, the Treasury Department, I don't really think much came out of that, honestly. So coming up in terms of, we have a rate statement, and then in tomorrow, you know, obviously this matters less. This matters very important in now what is a developing potential stoking of the inflationary deal. So, you know, I probably will do a little deeper dive as I build more research on this. But, you know, obviously the news that really matters, honestly, is the developed markets inflationary factors, right? CPI, PPI. I don't care if you're breaking it out into core or any particular sector. There's 20 plus sectors of industry in the S&P. They're all experiencing some sort of inflation that's being passed through to consumer. Hence the Fed trying to stave off or to crush by choice of open market operations for the FOMC. You know, obviously non-farm payrolls on Friday is key. You know, honestly, I don't really trade around any of these red folder events, honestly. Take a quick scan through the charts. Yes, honestly, for those trading any of the indices, MT4 or 5, the face rip rallies in bear markets, they're vicious and they're swift. So whether or not this one is a dead cat bounce or if it will continue to have legs on what is now an emerging theme that the Fed is looking to pivot again, which I just don't believe, right? But the market's thinking that, and that's why we're ripping. So, you know, we're late in the game as far as the slingshot question and getting short again. A lot of these indexes, I just would rather wait and see what plays out. You know, the argument could have been meant for bottom fishing, but a lot more work to be done in these charts in order for us to have any sort of bottom fishing area. Okay, so we've seen a tick up in the credit markets. You can see here, these are daily charts. Each day represents a single wick in our list of candles. So the not surprising thing is, as rates go up, the dollar goes down, right? Now one could say, well, the dollar's going down, so rates are going up. You know, however you want to phrase that, all I ever try to point out is the correlations between different asset classes, right? Why does that matter? Well, if you're seeing the one asset class that may be perfectly inversely correlated with another, right? Credit versus the currency markets, bond versus the FX markets, and this just doesn't be held to be just the U.S., it could be any of the bond markets out there. It always is that little canary in the coal mine that can maybe dictate where prices are going. But just looking at the chart of the U.S. dollar, even if I make this chart a little bit bigger, over the course, and these are daily candles, but over the course of what is basically a year that you're looking at, even though rates have come down, look how far we still have traveled, right? And I think that at some point, you know, we have to find, and by the way, this is support right here if you didn't know, so I'll show it to you on the other charts, but just as a heads up. At some point, you've got to find a balance area. You have to find a sideways movement type of trending in a given high and low, right? Oftentimes it will trade inside the previous period's value area, highs and lows, if you're looking at it from a market profile perspective. But just taking a look at the U.S. dollar going down, everything else has been going up. The crazy movements in sterling and this British pound movement here, it really is nuts. I mean, they come out with a tax and bailout package for energy, and then everybody hates it, and the markets completely freak out, and then they backpedal the package. I mean, really, as far as Liz Truss, she's a new prime minister, obviously, but man, between her and all the parties in the UK, they got to get it straight, because this was like a watershed moment in the pound. I said this the other day. This is almost like from a long-term perspective, maybe a great way to load the boat long and just hold, right? It already paid off for you handsomely in terms of the performance there. So, you know, I'm always trying to get you guys to think in terms of how do institutional traders think. Yes, this would be more of a long-term asset play, but still, the key is any type of extreme out, as I've often taught students over the years, can be played. It's one of the very few times I will step in front of the train. Ultra rare few times. But they happen. And it seems like they're happening a lot more in all kinds of markets, not necessarily just currencies. So, that is my thoughts on GBP. I would imagine we'll probably find some sort of semblance of balance. But the U.S. dollar has just got clobbered recently. But arguably went up too much, right? Those that will ascend, that will eventually descend, right? The rise and the fall. This was outside of many parameters of normal trading. It was stretched. It was due to a whole bunch of crazy factors, craziness in geopolitical events, shifting of monetary policies from an easing to a tightening by many different developed market central banks, right? Those are the important moves. If you're relatively new to these calls, I'm always talking a lot about macro themes and how they eventually will ripple out into the currency markets. I try to keep it really big picture. If anything, I've been going bigger and bigger picture recently, just really because of the fact that you know, one can go in and set levels for certain stuff, and most of these levels I'd be talking about, we've already seen them. And now it's really any man's guess. So I'm trying not to play the guess game, keep you guys out of trouble. Honestly, a lot of currency traders I know, they haven't been trading much. You know, and either have a lot of futures or options traders because things have just been so bananas. No surprise, you know, we've warned of this, but the VIX crowd, which is a group unto themselves, You know, remember I said to you guys, once we get over 27, you know, your win rates on almost any trade setup, when volatility is much higher, these win rates are lower, right? So from just a statistics perspective, or if we're going back and, hey Steve, we're going back to statistics class in college, yeah, the odds aren't there. So, you know, I've been focusing more on other things like this business, but at the same time, you know, I think that the problem with too many traders is that they feel an inordinate amount of guilt, if you will, they're not trading, right? I don't understand it. I really don't. If anything, I probably should be trading more than I do. You know, I almost trade, you know, little to a fault. I'm like the opposite problem. I should be trading more. And yeah, I don't know. I think if you could just do a couple of great trades a month, especially if you're working in a regular occupation or some sort of career, you know, it's a great side hustle, right? Your spouse may not need a job if you're good at it. You know, there's all kinds of cool things, including saving, investing, and more fun stuff, and, you know, whatever your goal is. If you want to give it to charity, you know, Godspeed. So the key really is you don't necessarily have to trade all the time. Positions of cash is a position, right? Somebody's like, I don't have any positions on. Well, technically you do have positions on. You're sitting in cash, right? That's a position. So I spend probably way too much time telling everybody, hey, you know, let your hearts not be troubled, but mostly because I do it for a living in an occupation here. But telling clients, you know, the same thing I tell you guys. You know, there's a lot of our clients that actually watch this cast as well. You know, some of them, maybe there's way too more of an in the weeds discussion of them. But for really any reason than none, they watch it because it just helps build confidence in our ability to manage their wealth. And the movements in these currency markets, as I'm showing just quite generally here, is just it's been nuts. So take a look in though. S&P, always willing to talk a little more about where levels are going because this is just a bit more predictable in equity land here. Actually, you're going to jump out of this and go into a weekly chart for this perspective here. Show this to you guys. So, where are we? And you can even argue to take out everything that we've put in until this area here, right? You would say this doesn't count. We'd only want to start about right here. So why did the market stop where it stopped? Well, there's the 200-day line right there. There's a whole host of other things that have come into play, but most of these moving averages, you know, they always say, hey, if the big one, by the way, this is a weekly chart, guys. So the 200-day, if you didn't know, actually, let me just go back. 200-day carries some pretty serious weight on a higher time frame. But also note that underneath this level, if you could follow all the way to the left side of the screen, you know, obviously there's volume down there in more condensed version of this chart with previous trading, right? But in terms of just this window, there's no volume down here, right? So what's that tell you? Well, the crevasse, oftentimes of lack of volume or no volume, will turn markets around. So they can't find any buyers, or I'm sorry, they can't find any sellers down here that hit the bid. They need to start lifting offers. And that's what we've done. We've already jumped almost 200 points in the S&P because of that. Now where do we go from here? It's really anybody's bet. Just wanted you guys to see the 200-day. If I go back to the daily, it tells a different story. So the importance of the 4,000 area in the S&P, that's going to be the big one. Let's drop down to NASDAQ. I don't know if a lot of you guys trade this stuff, but just look at the index as a whole. There's been a heck of a lot more carnage in this arena, which is difficult to see on this chart. It's much easier to see on this chart. which is a weekly. All-time high 16.2 on this. We've almost been cut in half. See that? Not quite. Arguably more than a third, but a third in the market value of this market's been wiped out. And, obviously that's led to a 30% down this year. S&P's off, somewhere in the area of 22%. So we got a pretty solid, keep in mind these are weekly charts, each of these candles. So we have a pretty solid floor at 10,673 and 13,000 on the upside, which we could absolutely face rip to and barbecue a lot of the shorts along the way, which is very common practice for markets that have seen increases in VIX volatility. And most people aren't expecting levels to get hit, which usually tells you those levels are going to get hit, right? Everybody thinks one thing, right? If you're looking on any financial media or social media, financially oriented, whatever, and you can collectively put an accurate assessment together that everybody's in one boat, you can bet something's different's going to happen. Why? Because it's already priced in the markets. If you believe in the efficient market theory, Markowitz, all that fun stuff, modern portfolio theory, much of this has won many Nobel Prizes in economics, whether you agree with it or not. Efficient markets means that everything's priced in. So as you guys know, I spent an inordinate amount of time looking at what nobody's talking about, right? Because if nobody's talking about it, then there's a better shot that it can happen. Again, we're staying real big theme in terms of the macro discussion here, but I want to train everybody, is my hope, or at least get most of you trained in that thought processes, because you're always going to be looking for two things. One, what's going to be the ripple effect or pin action off of a particular move, right? And, how can this affect broad movements and things? And as long as you're with the trend, which is typically easier, or your algo that's trading for you is with the trend, you just have that much easier time. Like when the dollar just kept going up and up and up, and I'm like, look, until it stops, which it very well may have at some point, unless things just continue to get a lot uglier than as far as the DXY is concerned, where they go right back up and visit the top here. So let me just take a look at the dollar now. I've got to go back to a daily chart for this one. To this whole 114 area, we'll go right back and visit there. But I think, could be wrong, we've got support right in this 110 area. So then potentially there is a larger chance that we'll spend some time between the two prices, 114 and 110. That would be my guess, and that's a guess at best. Now, on the case of the euro and the British pound, we've had 6 days on the pound of arguably, not all will agree with me, one-time framing up trades. What's that mean? That means that it opens higher if it's going down, finishes lower, right? Every single day. The true definition of one-time framing is if it opens up lower and continues higher outside of the previous day's range. But I'm not splitting hairs on the detail of that. As long as it's one-time framing up, it's a very powerful move. Many of these have a lot more power than many shorts in the marketplace think. Even though things may be bad, it's just completely overblown. So, when was the last time on a daily chart, right? You probably could say, well, I've seen it a few times through the pandemic, but that we've blown through a Bollinger Band by that level. I mean, that's just nuts. Look at the volume. I can't see this. Let me take a look. Look at this volume spike. Is that 1.5 million? Is that right? And that's, if you believe the volume from FXCM guys, that's a huge day. I don't think I recall any time it's ever been that huge. Let's see. Let's take a look at the weekly chart. Sorry if there's a lot of gobbledygook going on, it's hard to see. Don't pay any attention to any of the lines, just focus on the volume in here. One actually thing that's interesting to note, and you don't necessarily need a market profile chart to see this, but see all this blue on the left? You see how the center point, which is called the point of control, and this is all the data, right? So it includes every day where things move down into a lower range, right? I always want to look at the data, and only the data, at least from an aggregated volume perspective, in any type of market that I'm trading that has aggregated data in a lower play. I want to look at the whole thing, right? So in this particular case, it's just a 1 week chart of our entire trading in this arena. Look where the point of control is on this. It's way up there. So even if we completely ripped way back up there, which I just don't see happening, a 1 spot 3050-ish area is the center point of this. Now that's far away, obviously. And this is a weekly chart, so we're just trying to stay on macro themes. But if I drop it back to a daily, and this is a bit much, trying to get all this stuff in here, begins to look quite noisy. All the volume is much, much higher. So also note down here, we've never been down at this level. I shouldn't say never, but like almost ever. So there's no volume down here. So there's like not much you can read on. There's also no technical analysis, and that's why we went down, completely cleared the queue on all the misgivings of policymakers in the UK, and now we're coming back. It's almost like we're coming back to the parity or playing to some semblance of normal trading, right? And then we hit right up against one of the moving averages here, at least on a daily time frame, was our first point of resistance. But I think really we're at it. So there's a good chance this could spend between 1.15. I don't know if we're going to go back down and see the bottom again. Just know that if we did go back down to this level, which may not be revisited again, even though people will say, well, Steve, you've often told us that things will come back to the scene of the crime. Yes, but in the case of this, I think there was probably enough big institutions globally that were buying down here, just in that off bet that they'd catch somewhere near the bottom of this and be able to hold, because they'd spend the rest of its time, let's just say the rest of this year in this range, this 120 to 114. It's a hell of a profit on that position. Just remember that. Remember, the large big players typically, not always, but the large big institutional players in these currencies will often make trades in these things that can last 3, 6, 1 year clip as far as the investments in the currency markets. Okay, so as goes, the dollar, obviously, as goes this, as goes very little we've seen in this, right? Just to show you how weak the yen's been recently, right? We've seen some pullbacks and a lot of stuff. Just going to rip through these charts real quick. These are all dailies. CAD JPY showed, actually have not shown Euro GBP recently, but there you go. Look at that. Remember, I always joke, I don't really ever show this because like nothing ever goes on. Yeah, wrong. Look at that. There's the reaction, obviously, with that complete drop in the in the British pound, right? For once, the euro just totally ripped. It's actually kind of interesting because there's actually probably a time when I was almost giving back to potential parity. Look at that. Alright, GBP CAD. One thing I did, I don't think I have it in my, let's see if I can find this. Yeah, I don't know where it is. I had a really good, I think I probably could have found it on. Yeah, I'll see if I can find it for Saturday. It's pretty good additional ways to look at, kind of how currencies trade, intertwine with each other. So I'll see if I can get something together for you guys on that. Take a quick look at the rip in gold, right? Trading correlated with equities. Crazy, huh? Not normal. And then obviously, it's almost like everything was risk off, right? And with the exception of the dollar, that was risk on, and everything else was risk off, almost exclusively. That's like the dollar was completely uncorrelated with every other asset class out there right now. And it goes the opposite of everything else. It's just the strangest thing. But just note that, we're coming back down on VIX a little bit. Something definitely to keep an eye on, because now we're in what's called an elevated area, right? It's almost like we've made it past DEFCON 1 and 2, and now we're into level 3, right? So you always want to be a little more aware of potential spikes in this. Anything above this area right here is, much higher level of volatility, much more movement. The interesting thing that the bears will tell you, at least in equity land, is that the volatility rate doesn't show fear, even though we've seen a 20, let's just say S&P 25% decline. It's worse in tech stocks, and it's a lot worse in some other sectors that have been absolutely clobbered in other areas of tech. But normally you want to see a crescendo, kind of like a pound type movement in the VIX to be a buyer. So, say you're an institution out there, you sold a bunch of stuff, you got quite lucky, you didn't catch any of this downdraft in equities in your at least the equity portions of your portfolio, and then everything settled out, but the VIX never spiked. So you have all those McClellan oscillators and VIX folks out there saying, well, these never registered. We hit a bottom levels. So it's almost like, wow, it's been a really orderly sell-off. And the answer is, we're almost all the way back to where we were in the complete rip in 2021, right? So in the grand scheme of things, we're not that far in a correction. And, probably some of the best, and this is always the case, it depends on the area of the world, but at least as far as this country, a lot of my trader buddies I kind of run with a little bit here and there. Some of these guys run investment firms, and, we talk occasionally via whatever, and, they're all just basically, we're all on the same page, as I've been talking about for the last few. There just isn't that much pain out there, right? I mean, there is in other areas, don't get me wrong, but, he quoted a whole bunch of stories that there's not enough pain out there. You can't curb inflation and push off until you're really hitting the people that are causing the inflation. We're not doing it yet. So this would be a very strong argument for Jerome Powell and the Federal Open Market Committee, right, the FOMC, to be making as to why they kept and they will keep raising rates. And there are some people that are seeing some pretty serious pain. Our hearts obviously go out to all our South Floridian partners here, that have been affected by the storm. They certainly have felt it, but in general, most of the decently organized or well-developed countries, with the exception of energy in Europe, really haven't felt a lot of pain. And markets don't bottom on stuff like that. They bottom when it's just throwing the baby out with the bathwater stuff. You guys recall back to 2008. I mean, everything was just getting crushed. People were crying in the streets, and housing markets blowing up, right? I mean, that was some serious pain. And, you know, the ashes or the end of the fire smoldering, if you will, of asset classes blowing up always end with those types of actions. So I know that seems quite dire and not, but, you know, I'd rather have you guys err on the side of caution here from a risk-off standpoint than be running around going, yeah, Steve said we hit the bottom and now we're rallying equities. I just think we need to experience more pain. It's not like it can't come fast, obviously, but I don't know. You got to have sort of these. I'll keep referring back to this British pound waterfall moments for you truly to have hit some sort of reversal, right? And we'll see if in fact that is the case with the pound, or if we actually go back down and visit the lows again, which I think would just be, you know, max pain again, right? You're catching most of the people off guard most of the time, which is really, at the end of the day, the function of what most markets want to do. They want to catch you off guard. The other thing of note, if we look at a weekly chart of the coinage, just as I'm going to end here, let's reset the scale. Now, with the coinage, it's a different story. Because I got to tell you, and maybe it's just been low volumes, people are paying attention to other stuff, you know. I would certainly, you know, just because of my lack of general in-depth knowledge on how this asset class trades, it's more the Wild West, but I have been quite surprised that, you know, and again, these are weekly charts, so, but we really haven't had any kind of watershed moment here, you know? And you would think with all the risk off that's going on, they'd be throwing this out. And what this probably tells me is that those that are holding in this area, maybe from lower levels, or those from much higher levels, right, are trading roughly 1/3 of where we were at the high. A lot of people have gone through a lot of, maybe they've written it off, right, in their mind. And I know, which is actually a healthy thing to do going forward, but at least from an inner monkey standpoint of sanity. But I haven't seen the sell-off like I thought we would. I really thought we'd see something a little further down. Yeah, because ideally this thing, in half its value, will have flushed out probably every person that got in much higher, and even some of the biggest institutional whales that are holding on for dear life here, right? Just hasn't happened. Ideally, this would be a better investment, my opinion, if it was trading somewhere between 5 and 10 in terms of long term. Who knows? Maybe you get a rip back to 20 on that. That is my thoughts in crypto, as half-assed as it may be. What else do I want to talk about? GBP, NZD. I thought this was of note, by the way. Crazy currency pair. Look at that. Nothing like 1 week to completely traverse the entire range you've been trading in for a year. Isn't that crazy? Boom. All the way down, hit the bottom, right back, and completely crossed over. Right? So if there's no interest, you know, beyond, I mean, obviously this is a watershed moment, but if there was no interest further down, right, nobody's hitting the bid, and they have to keep lifting offers all the way, oftentimes, if it's rejected here, it's going to completely go back to the other side of the range. Beautiful, beautiful example that I wanted to show you guys then. And with that, if you guys have any questions at all, hit me up on the Telegram, which seems to be a dying medium of communication. But you can always send me an email as well. It's just svetterl@AuvoriaPrime.com. Happy to help out and steer those in any wrong direction, or if you think that I am wrong and you want to make a comment on, you're more than welcome to do that. You can also follow me on @fxestrader.com. Wish everybody a great week, and may the trades be with you.